everyone, it's Sumit. So with rising real estate prices, increases in demand for homes, and more people looking to get into the real estate investment game, it becomes overtly important for a new real estate investor to have clear line of sight in terms of what is it that their rate of return is going to be on an investment property. And there's tons of calculators online that cover off on this subject matter in some way or another, but what I can tell is that a lot of these calculators are lacking in some way or another. So it's important for a real estate investor to understand, what is my profit and loss statement going to look like? What is my cash flow going to look like year over year? Is this a compelling investment? What is it going to look like when I sell the property? What is my realized rate of return going to be on a particular investment property? And that's what I want to talk about in this video. What I've effectively designed is a slightly better mousetrap, arguably. And as I've talked about in other videos, all the spreadsheets that I use in this particular channel are all available for free. Just include a comment below and I'll be sure to get these spreadsheets out to you. Without further ado, let's get into the spreadsheet, because that is, after all, what we're all here for anyway. So what you'll see face value in the spreadsheet is you'll see some yellow cells. Yellow cells are all input cells, so you'll need to modify them based on your own specs and circumstances. The white cells is what I would suggest not mucking around with a whole lot, because they're calculation cells. And when it comes to any of these gray type of cells, they may require some level of modification just based on your own individual facts and circumstances. So when you have some of these yellow cells, you have to include some basic values when it comes to your particular circumstance. I have put in some values that I just thought were appropriate for my own circumstance, but for yourself, it may be significantly different. So this part is pretty straightforward. What is your purchase price of the home? How much of a down payment are you putting in? What is your mortgage rate? I put in a slightly higher mortgage rate because the key thing to note when it comes to investment property is their mortgage terms are usually a little bit less desirable than when it comes to just somebody looking at buying a home for their own personal reasons. Loan term, again, pretty straightforward. Property taxes, homeowners insurance, HOA, dues, closing costs, all of that is going to depend individually based on the circumstances that you're in. Pretty straightforward stuff here when it comes to monthly payments or an amortization calculator worksheet. This will give you line of sight in terms of how much it is that you will be paying on a month-over-month basis, just purely on the property. We're not even talking about any of the rental type of income at this point in time. If you want to see the amortization schedule, it is all available right here in this amortization worksheet. Now, one thing you will note, because I've quickly glossed over it, but when it comes to the payments over here, it is basically saying that you'll have $811 in payments over month when it comes to the property. And you look at it over here, it's basically saying it's $1,281. There is a delta between the two because it's the $811, plus I've also included property taxes, plus I've also included homeowners insurance. So when you factor in those types of pieces, obviously your monthly payments is going to be a little bit higher than what an amortization calculator would perhaps suggest. And then we start getting into more of the fun part of the calculator, if you will. Okay, so the first thing that you need to derive when it comes to these properties is what is the cost basis of the property. Okay, so certain properties you may get in investment property and you may decide that I'm going to do some improvements to the property which could potentially increase its value. Some properties you may decide that, hey, I'm not going to make any changes, it's in pretty good state, I may just put on a layer of paint or something and then basically rent this thing out. So that is not all that significant. So you need to provide the cost basis for the property based on your own individual facts and circumstances. The other thing to note here is when it comes to the cost basis of property, you need to exclude land, okay? So we're just talking about the building and its core at this point, okay? Because that is very important when it comes to this whole depreciation recapture piece. So what depreciation recapture is, the IRS basically allows you to have certain amount of depreciation expense that you basically record on your IRS 1040 statement, where you would put in some of your depreciation expenses. And this is very important when it comes to realizing whether a property is a good investment or not. The challenge is really this: when you go ahead and sell that property, assuming you do not plan on holding this property forever, then in those circumstances, what you essentially have to do is you have to do a depreciation recapture, which basically takes into account that all of those depreciation expenses that you recorded early on in the property value or its property life, in terms of when it is that you actually held on to it, you basically need to net that out on the sale of the property, so it effectively erodes some of the realized gains that you may have on the sale of a property. So anyways, that's why cost basis is very important. It's really your purchase price plus improvements minus any land costs. Then we have to talk a little bit about estimated annual property appreciation. What is it in your area that you think the property is going to appreciate? Because that is obviously going to be important as it directly correlates to what the sale price of this home is going to be. How long do you plan on holding the property for? So for example, we've already talked about 30 years when it comes to the loan term, but you may decide to just hold on to the property for 10 years and then sell it at that point in time. But that is another important consideration which a lot of calculators that are online do not effectively factor in. What is the selling cost going to be when you sell the property? Remember, as you own the property, when you sell the property, you have to pay the real estate commissions on both the buyer's end and the seller's end. That is why this is at 6% as opposed to perhaps 3% that some people may be very used to. What is the rental income that you're effectively going to see on this property? What are your annual rent increases, your cost increases? Because every cost that you have, whether it's your repairs and maintenance, all of those costs generally go up over time. So you want to have some factor baked in terms of what is that perhaps going to look like. Estimated monthly repair and maintenance. So this is, you just put in a number in there. Other expenses, and this could be if you have a property manager, things like that. It could just be anything that falls into this bucket, but you do want to have some line of sight in terms of what is that going to perhaps look like. So once you have all of those inputs kind of put in, the calculator will really spit out how much of a rental income it is during the holding period and what your expenses are going to be during the holding period. And in this particular circumstance, what you can see is that there is in fact a net loss when it comes to holding this property over the extended period of time. And then we go into this depreciation piece, which is, as I mentioned a couple of times now, is very important. Typical rental income or investment property is basically depreciated over a 27.5-year period based on certain IRS rules. So what this will effectively say is for a property that is about $150,000 on a cost basis perspective, you have to divide that by 27.5, and it'll give you some line of sight in terms of what your annual depreciation is going to be, which you would apply on your tax return and could potentially be very beneficial. It's going down a little bit further on the spreadsheet. At this point, it'll basically tell you about what your first year P&L is going to look like. Okay, so what is your rental income going to be? What are your rental expenses, your closing costs, your total cost of the property ownership, and what the property gain or loss on that particular property actually is. The key thing to note here, this is year one. So when it comes to year one, you're going to have certain costs that I've highlighted in this reddish, maroonish color here that basically talks about, well, you have certain initial costs that you need to factor in, and therefore when it comes to real estate investment, your first year can perhaps be a bit of a bloodbath, but then you start recuperating a lot of these costs over time. So what this is basically saying is that in your first year, you're effectively deriving a loss of about $50,000, and then you include your depreciation component, and then your total IRS deductible loss is a bit over $53,000, okay? So, but at this point in time, from a netting effect perspective, you are gaining a little bit of equity in the property, so all is not lost. And to give you some line of sight, because if you're looking at these numbers, you may be in the impression that, hey, man, why are we talking about this property since this property is essentially such a major loss? But what I'll show you is over time is things start getting quite better and better. It's just about how long you're effectively going to be holding on to this property for. So if you look at the second year P&L as an example, things start getting a little bit better. Okay, and again, these are all calculated cells, so you don't need to actually enter anything into it. But at this point in time, your profit or loss, or the loss associated with this property, is only $5,000 because a lot of your initial investments that you had to make when you obtain the property effectively go away. Now, I do understand that some people may be quick to argue that, hey, closing costs can basically be straight lined over the life of the property and things like that. I understand that, but when we're talking about $3,000, it's overarchingly immaterial when it comes to this particular circumstance. But anyway, so in your second year, you basically have a smaller loss. You still have your depreciation expense, so you could claim with the IRS a larger loss or more paper loss than the loss that you're actually expecting in your wallet. And then your equity on your property is, of course, continuing to increase over time. If you go to one of these other spreadsheets over here, it will basically tell you what this P&L is effectively going to look like year over year over this entire holding period that you have for the property. So one of the things that you may want to think when you're potentially investing in some property that has these types of numbers is that it may not be as compelling of an investment as you were perhaps potentially anticipating, because you are going to be going through a bit of a grind while you actually hold this property. But things, like always in real estate, they do get better, okay? So when you actually go about selling your property, right? So forget about year 3, year 4, year 5, because that, as I talked about, is all available on this particular spreadsheet here. But when it comes to the sale of your property under the 10-year, here's what your numbers may perhaps look like, okay? At this point in time, due to the appreciation of the property at about 5% a year, you have a very compelling gain when it comes to this property, okay? So here's what your selling costs are going to look like. As I mentioned, is perhaps based on that 6% commission. Your dividend recapture piece, you need to net that out. Your closing costs on the original purchase, all that money you basically put in when you had to buy this property in the first place. There are variable costs associated with this property. And then your interest payments that you have been making to the bank. Now, I fully understand that there is a partial recovery when it comes to taxes for a couple of these line items here, but this is a conservative view in terms of what is it that you may potentially realize on this particular home. So it's basically saying that your gain and loss on this property is about $158,000. So while you went through a bit of a grind, you had some paper losses, you had some real estate losses, or some real losses while you held the property. It's not all bad, right? And you actually came out looking pretty good, because the key thing when it comes to a lot of investment properties is also the underlying appreciation that takes place with any given property. And just for a frame of reference, what I did also include here is your S&P 500 return, okay? So if you had taken that $43,000, okay? So I mentioned $43,000 here because if I go all the way up, what I've said is you basically put 20% down, right? So that's $40,000, and you incurred about $3,000 in closing costs when you originally bought the property. If you took that $43,000 and on the S&P 500 invested that in, and just to get returns from the stock market as an example, you would basically derive about an 8% return based on historical averages, and over a 10-year period, that investment would be worth about $86,000. I know we're in a bit of an irregular market at this point in time where people are generating 20+% returns investing in the S&P 500, but for all intents and purposes, generally speaking, over the grand scheme of things, the market just realizes about an 8% rate of return. So what this will effectively tell you is how much more compelling it is to do this particular real estate investment over perhaps investing in the stock market. So I'll pause there. There's a lot when it comes to this spreadsheet, okay? This was the summary tab, as I talked about earlier, right? And then when you talk about this spreadsheet over here, or this particular worksheet, will give you some of the specific math in terms of how I derived a lot of the costs associated with this particular property based on those inputs that you provided. This spreadsheet or this worksheet will talk about your amortization, and this spreadsheet or this worksheet will talk about what your appreciation on this property also is. So the more you play with it, the more comfortable you're going to get with the spreadsheet. I've included some notes in here and things like that, such that it's very user friendly and people just have to enter a few things, and then it's basically calculating and presenting a lot of things over to you. And you could even utilize a lot of these numbers when you're plugging in your tax return on an annual basis. Hopefully you've got some line of sight into all of this and you found value to this video. Definitely smash that like button, subscribe to the channel, ring that notification bell, and I'll see you in the next one.